Hi and welcome to Swissquote's Daily Market Talk. It's Friday, 15th of August. The US inflation data this week showed that Donald Trump's tariffs sent producer prices higher in the US in the month of July, warning that the abnormally soft CPI data so far is probably just about to pick up as well. So the letter may not derail the Fed from cutting the interest rates in a September meeting on heavy political pressure, but that 25 basis point cut, and probably not more, could well be the only cut from the Fed this year. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the Fed does hit a wall yesterday after the PPI data came in strongly higher than penciled in by analysts, putting in doubt that consumer prices won't be affected by Donald Trump's heavy tariffs and that the Federal Reserve in the US could wholeheartedly go ahead and cut the interest rates as much as the US government wants. Because in numbers, the headline PPI figure from the US surged from 2.4 to 3.3% in July versus a rise to 2.5% expected by analysts, while core PPI figure jumped more than 1 percentage point from 2.6 to 3.7% versus 2.9% expected by analysts. So the jump that we saw in the PPI figures was big, the biggest in 3 years indeed, and the Fed those were actually caught by surprise. So the combination of this week's CPI and PPI numbers from the US actually means that the companies have mostly eaten the tariff costs, as would say Donald Trump, but there is a chance that these costs will next be passed on to consumers. So if the Fed was navigating through normal times, they definitely wouldn't rush to cut the interest rates in September and totally avoid delivering a jumbo rate cut that could then further boost inflation and inflationary pressures in the US and eat the Fed's headroom for dealing with potential economic slowdown. But as we all know, times are not normal and the pressure from the US government and Donald Trump himself is mounting. As such, the September rate cut from the Fed will likely happen come hell or high water. This is why the probability of a September rate cut remains high at 93% for a 25 basis point cut. A 50 basis point cut is hopefully off the table regardless of the outside pressures, and I believe that 25 basis point cuts that we will probably see in the Fed September meeting will be the only one that the Fed would deliver this year. So the US 2-year yield jumped yesterday following the flashy red PPI numbers. The US dollar index rebounded but remains offered near the 50-day moving average, while I have no idea whatsoever why the S&P 500 and the likes have given no to very little reaction to the PPI data, because the companies are actually apparently eating the tariffs, and that will certainly show in the next earnings season. Then the Federal Reserve should not cut the interest rates. If it does, it will be delivering rate cuts by force that could even not help reduce the borrowing costs altogether if the markets don't align. Yet the risk appetite is full on. The market is probably broken and not reacting to the news as it should and probably overheating right now. It doesn't mean that there will be a market or a risk sell-off in the short run, but it means that the rally that has been backed by strong earnings and dovish Fed expectations, well, seems to be sitting on quite a fading ground. Voila, that's my opinion. Now today, the retail sales data from the US will give us a hint on how the US retail sales have performed last month with not much inflation. I think it should be okay. But the Michigan's data will also give us an update on how US consumers feel and their inflation expectations. Inflation expectations is, to me, the piece that matters the most for Fed expectations. And heating up in inflation expectations could eventually further hit the dovish Fed expectations, and that despite the US government's push to cut interest rates. Now, on the individual front, the news get messier by the day. Intel actually jumped 7%, even more than that yesterday, after the US government said that they are thinking of building a stake in the once iconic US company. But this time, last week, Trump was actually calling for the resignation of the company's new CEO, Mr. Lip Bhutan, for having an undesired track record for investing in China. The two men then met at the White House, and now all seems to be, well, they're friends apparently. So if you put the pieces together in the US chip industry, the US government will be getting a 15% cut from Nvidia and AMD's Chinese sales and invest in Intel, which was actually originally not really willing to expand its production plans before confirmation from clients that they will be buying their chips. So while the Ohio plant would be the biggest chip factory in the world, churning out chips that the clients don't want isn't exactly a solid foundation for capital markets. So Donald Trump is probably gearing up to play Santa for America's chip industry, but mixing up the chips on this board could, well, prove a game that will give cold feet to investors around the world. Beyond the US, the news is mixed but more traditional. The UK growth numbers came in yesterday stronger than expected, soothing Rachel Reeves and making the Bank of England watchers scratch their heads about what the Bank of England should do next with its rate policy. Even though UK's growth is slowing, it doesn't look alarmingly slowing right now. Inflation is rising on the other hand, and these are the arguments for those who are not in favor of another rate cut in November from the Bank of England. On the other hand, the hard fiscal policies and potential of further tax rises in the autumn budget could be another hit to UK's growth and bag another rate cut from the Bank of England. But the Bank of England cannot act on speculation about what the government will or will not do about its tax policy. Therefore, we have to wait for the autumn budget for more clarity and keep our options open for a rate action in the UK in November or not. Now, in the FX, cable reached 1.36 level yesterday, but the pair came down on the back of a broadly stronger US dollar, yet the euro pound just slipped below its 50-day moving average. The move was also backed by a softer than expected set of growth data from the European Union economies. GDP there grew only 0.1% in the second quarter as expected by analysts, perhaps held back by tariff uncertainties. Industrial production fell more than expected as well, while employment grew less than expected in the second quarter. So the set of soft-looking data from the European Union kept the European Central Bank dose at check yesterday. The euro-dollar remained supported into its 50-day moving average and is actually better bid this morning against the US dollar, but with little change to European Central Bank expectations. That is actually a post-rate cuts in the next meeting and potential cuts into the year, and depending on the economic data, while the euro-dollar's direction will certainly remain heavily influenced by the moves in the US dollar than the moves or the potential expectations or change in expectations for the single currency. Elsewhere, the GDP figures came in higher than expected for Japan, while industrial production, investment and retail sales from China disappointed. In the energy space, crude oil consolidates gains after a nearly 2% bounce at yesterday's trading session as traders priced in geopolitical risks due to potential escalation of tensions between the US and Russia after Donald Trump warned yesterday of severe consequences, including further sanctions if Ukraine peace efforts stall. So the upcoming meeting between Putin and Trump indeed carries a higher chance of going toward the wrong direction than going toward the right direction, but the direction in the oil markets will obviously depend on the outcome and the potential consequences of that meeting for Ukraine, for Russia, and for oil flows. From a price perspective, US crude has recently cleared a critical $65 per barrel support, remember, and is now consolidating losses in the medium-term bearish consolidation zone. The combination of ample global supply, especially with OPEC supply, and cloudy global demand actually backs further losses, while a broadly softer US dollar could actually limit the potential losses here into the $60 per barrel level. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please Do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.